our guest tonight is Vessi. Pronounce it again, Vessi, for me.
Kapoulian.
Kapoulian. There you go. So I want to make sure. I don't want to trash nobody's name, right? Vessi's from the West Coast also. She's in California, right? And San Francisco, right?
Los Angeles.
So LA. Okay.
South, yeah.
Okay.
A little bit
LA.
south. Yeah.
LA. And not only she in the last this year alone, she closed on 2 multifamily properties, an 11 unit and a 145 unit building within a month apart, right? But in addition to that, she also has 18 years in the business finance area, and 14 of those 18 years she's been in commercial loan division. And this is that she also has a fur baby, right? And she's also a marathoner. So, Vessi, I want to say thank you for coming on. I appreciate you. And I just want to say right quick, I remember when Vessi first came on the meetups, when we first started meetups, Vessi was real quiet and laid back. But look at you now, Vessi. You are blown up, right? And I'm going to add one thing too. Vessi loves numbers. She loves underwriting. So Vessi, tonight's going to talk about her story when she started from 2017 to now, and talk about a little bit about underwriting. So Vessi, the floor is yours. Thank you for coming on, taking time from your busy day to come on Financial Independence through Small Multifamily Investing. Appreciate you.
Thank you so much, Lawrence, and really appreciate the very warm welcome, very warm intro, and really excited to be here today and talk about my journey through real estate and hopefully sprinkle a lot of nuggets of wisdom along the way and add value to the audience. So let me share my screen. Make sure you guys can see that. Can everyone see the screen? Hopefully that all works.
I see it.
Yes, perfect. All right. So we can go ahead and get started. As Lawrence and I were chatting earlier, we were thinking what would be some topics that would be interesting and relevant to the audience. And there were 2 common themes that emerged. One being going through the journey of getting that first deal done, which often is the scariest, the most difficult one. And shortly after, somehow by that law of the first deal that you may have heard people talk about, the next one shortly follows. And in particular, also briefly talk about underwriting and specifically how I've leveraged the power of underwriting to evaluate deals and make those investment decisions. So very quickly, as my attorney would advise me to say, the presentation here is not legal, accounting, tax, or individually tailored investment advice. Past results do not represent or guarantee future performance. So the topics that I briefly mentioned will cover, I'll discuss briefly my background, getting to and getting through that first and second deal, underwriting, especially in the current environment. And I do like to leave ample time in the end for questions and answers to ensure I provide you with the information that's most relevant to you. So with that, we'll get started. And I arrived here in the I'm originally from Bulgaria, arrived in the United States many moons ago with 2 suitcases and a lot of hope, faith, determination to make the American dream a reality. Didn't come from a family of means, but I would say growing up in Bulgaria behind the Iron Curtain, for many people, there wasn't a developed stock market at the time. So for many people, when they mentioned the concept of investments, they were often referring to 2 things. Possibly buying your own house and investing in other hard assets like gold and silver, usually in the form of jewelry. So it wasn't until I arrived in the US until I discovered the stock market, but I never really quite warmed up to it. Very much resembled, I don't want to say gambling, but lots of uncertainty. and set on a path of what I would call more traditional path of going to school, getting good grades, and then getting a corporate job and sitting on a journey to climb that corporate ladder until I would say probably 2017, when I stumbled across a real estate seminar, and I figured, well, I lose nothing by going there, learning some more. It was a 3-day event, and the seminar itself ended up being an upsell, but there was a lot of what I thought useful, valuable information in there. And so I took copious notes and effectively built templates, checklists, and whatnot, information that could get me started looking at various deals and real estate. On and around that time, I also came across an online real estate meetup, and one of the speakers at that meetup was consistently leading discussions or leading the presentations, and he had his contact information in there. So I figured I would pick up the phone and call him. So that's exactly what I did. And I asked him, hey, do you know of anyone who sells properties out of state? And lo and behold, he did. So at that point, you could say that a real estate seed that was planted in me a while back in Bulgaria started germinating, and I took action. And before I knew it, I had my first real estate property out of state. And that led to another and another and another, mostly single family homes, or there's one duplex in here. And I asked myself, well, this is all great and fine, but how do I scale this further as I started seeing the power of real estate investments and cash flow in particular? And the next natural area that emerged was develop into multifamily, continue investing into multifamily. So I started devouring, and that was around, say, summer of last year. So I started devouring a ton of content, and one common theme emerged at the time, particularly with people who are experienced or established, already successful. And that was to get a mentor, join a coaching program to accelerate your growth and development, and hopefully also help you avoid some of the mistakes along the way. And I figured, well, I will just follow in the footsteps of success of those wise folks. And at the time I started looking into various coaching programs. I selected one and had set a goal to be able to close on my first multifamily properties anywhere between 12 months of making that conscious choice to make the transition into multifamily, or at the latest within 12 months of joining that coaching program, which I started fourth quarter of last year. And happy to share that, as Lawrence mentioned at the beginning of the call, that dream is now a reality. It started with an 11-unit JV in Tampa, which was followed by a 145-unit syndication shortly after. And that one was in Georgia. And so instead of walking through the deal specifics, what I thought I would share with you are some key takeaways from doing that first deal, or frankly, those first two deals, because there were definitely a lot of learnings along the way. It wasn't smooth all along the way. It wasn't all daisies and roses and butterflies. And of course, if it was easy, right, everyone would be doing it. So I would say start with having a clear goal and knowing your investment criteria. The world of real estate is very rich. There's so many avenues that you can follow, whether it's commercial real estate, residential. Within commercial, there are numerous asset classes, property types, markets. And if you're more experienced, maybe it's okay to be more spread out and do a little bit of everything. But especially when you're starting, it can be very overwhelming, and you can very easily get distracted by the so-called shiny object syndrome. So I would say, particularly for those that are still early in the journey, is to be very clear on what are your goals, what is your why, and what are your investment criteria? And from there on, zero in on the market, the asset class. In this case, for me, was multifamily market. For deal sourcing, for me, that was Florida. And that will also help you later on as you start evaluating opportunities, members. It allows you to be more focused, more efficient as you execute on deals. Next is educate yourself. And that's an investment. Invest in your education, because you have responsibility not only towards yourself and your family, but in this case, you have fiduciary responsibility towards other investors, whether it's active investors like your JV and GP partners, strategic partners, as well as passive investors or the LP. When you go to the dentist, right, you expect them to have gone through some proper form of training. And naturally, when you're working with investors, they would expect you to have some proper form of training. Now, is joining a coaching program a must for everyone? Probably not for everyone, but it was the right decision for me, because it helped me continue to further my education in the multifamily space in a more structured manner. It also gave me access to a network of like-minded individuals and access to a coach, a mentor who could help guide me along the way, and also help accelerate my journey. I mentioned people and partnerships, and oftentimes you will hear in real estate, location, location, location is key. And that's not necessarily wrong. I agree with that. But I would say just as equally important are relationships, relationships, relationships. This is a people business. This is a team sport. And yes, you may be successful executing perhaps on a smaller multifamily unit entirely by yourself. But in the long run, if you're looking to scale, or if you're starting to look at larger properties or different projects and development and whatnot that are more complex, you will be working with people, whether that's JV and GP partners, mortgage brokers, insurance brokers, property managers. These are the people that help you take the deal down, help you manage the deal, or brokers that help you find the deal. And so relationships are key in success for this business. And finding also the right relationships, aligning yourself with people who have similar values. And speaking of values, another learning is find a way to add value. Oftentimes people ask me, particularly when I talk about the 145 unit in Georgia, well, how did you find the deal? And my answer is, I did not. It was my partners who are local to that market and who focus on that market who found the deal. But how I got brought onto the team was by adding value through underwriting, being that second set of eyes on the numbers. A little sidetrack here, those particular partners are part of the same network. So I was very happy to be able to work with them. And during one of the events, there was an opportunity for people to raise their hand and do a presentation on their market. I had recently joined the program at the time, and I raised my hand, even though it felt very uncomfortable, but I figured, well, you only get better by overcoming your own fears and personal beliefs. So I raised my hand thinking there will be a long list of people waiting to present about their market. And I found out there were not too many. So I ended up doing that presentation pretty early on the journey, but it did well, and it got very positive feedback. And so when those GP partners saw the presentation, between that and coupled with the underwriting and the analysis I was able to bring to the table, ultimately we decided to work together. So being uncomfortable, finding ways to add value and help others, because at the end of the day, that's what it's all about, right? Being able to help other individuals be successful and accomplish the goals that they like to accomplish, whether it's adding value to your GP partners or adding value to passive investors who are in search for opportunities and ways to diversify their portfolio. I talked about overcoming your fears, and ultimately it boils down to what are you willing to do to get outside the box, stretch yourself, and achieve your goal. By the time I had found the deal that I sourced in Florida, I had underwritten nearly 200 deals. That's almost a deal a day. And of those 200 deals, only a handful penciled in sufficiently that were worthy of an LOI. And of those LOIs, only one was really accepted, or meaning one we won. And it can be discouraging at time, right? Looking at 200 deals and most of them didn't really pencil in. But it's important to stay true to yourself and going back to knowing what your investment criteria is. And what that also taught me, what that also taught me, it made me a better underwriter by going through the reps and underwriting all these deals. But it also helped me learn the market, because the more deals you look at, you become more familiar with each area, neighborhood, submarket, so you can better evaluate potential rents, particular expenses, and whatnot. So it's going through the reps, doing the work, taking those daily steps, and just staying focused on taking action and being consistent, and knowing that with that persistence, consistency, and hard work, the outcome will follow. I talk about taking action, and that kind of leads into the next point, which is do not wait for the perfect deal. If I was very rigid right around my criteria, no, I will only invest in Florida, I probably would have never had the opportunity to do that syndication. But the people were great, the numbers and the deal were great. And so that was a no-brainer. Why not jump into it? Same thing with the 11 unit, right? It's I will talk about how we started the deal, and it was intended to be a forever buy and hold. Now that particular deal had multiple exit strategies, but in the middle of the deal, we got an email, not even a phone call, an email from the lender saying, hey, we're putting our loan products on freeze, and I'm not able to provide any further quotes. Good luck. And that was very difficult, right? Because that was not what we expected to hear. And we were sort of back to square one, where we had to start looking for a new lender, loan products, and ultimately decided to pivot and proceed with one of the exit plans and make this a shorter term hold versus a forever buy and hold. So will that be the perfect deal? Only time will tell. However, the learning that you get out of it from not only finding and underwriting the deal, but going through the actual diligence process, now having a team or partners that you work with, strategic partners like loan brokers, insurance brokers, and whatnot, you learn along the way of who you want to work with for your next deal, and so forth. And those learnings are invaluable. You cannot get those from reading enough books or watching seminars. Being transparent, do the right thing, and walk the talk. Having to communicate the difficult news about our lending situation to the broker, it was devastating. Mind you that this was my first deal, or our first deal, with that particular broker, that particular seller. Our reputation was on the line. But following the ostrich approach and hiding your head in the sand and hoping the storm will pass away doesn't usually help. So I picked up the phone and, of course, had to share the bad news with them. Of course, I didn't just drop the bad news and run away. I had a plan of action. I had reached out to a number of other lenders at the time. And throughout the process, I kept the broker and indirectly the seller about our progress and how many lenders and brokers we have spoken with, how many we've narrowed it down to, who are we moving with, what are the timelines. So keeping that communication channel open was important. And if anything, I think it ultimately brought more credibility to not only for us as a team, but for the process as well. Similarly with the partners, right? We initially all walked into the deal with certain expectations of returns based on the loan structure that we had at the time and the forever buy and hold timeline, and that changed. So we had a decision to make. Do we completely walk away or not? And there were additional profits to be extracted from the projects, but it involved proceeding with one of the exit plans and pivoting. And so it was doing the right thing for the partnership team at that time. Again, not an easy decision, not what we all signed up for in the beginning, but it's about, again, being transparent and doing the right thing with others. And last but not least, which will lead into the next topic, namely underwrite conservatively, especially in the current market environment. I often tell people that ask me, what is the first thing or one of the first skills that you would learn when you start investing in commercial real estate and multifamily? And I say underwriting, because even if you choose not to focus on underwriting down the road, even if you choose to proceed with attracting capital or asset management, you need to be in a position where you can evaluate the deal, because again, you have fiduciary responsibility not only to yourself and your family, but to your investors and your partners. So you don't have to focus on doing underwriting later on, but at least take the time to learn how to evaluate a deal properly. And as you're going through that process, fall in love with the numbers, don't fall in love with the asset, especially in the beginning, right? That's very, very tempting. You're eager to do that first deal, jump into that first deal, but be patient. No, this is a marathon. It's not a get rich quick process. So it may take some time, especially in the current environment, to find the right deal and make the numbers work. So with that, I wanted to share with you a few underwriting basics in the form of a checklist, cheat sheet, roadmap, however you want to call it, or at least the things that I look at as I approach a deal. The first one is knowing your market and submarket. You will be surprised how frequently I get presented with deals, and the natural question is it a good deal? And the first thing I do is do a quick scan or a quick review of the market, and I can share with you my criteria or what sources I use if you have an interest in that. But there are a lot of factors that can market factors that can impact your property and your business plan, right? There are a lot of things you can do to improve the property, whether it's catching up to deferred maintenance, changing branding, improving curb appeal, updating the units, but you cannot necessarily move the property. And so if, for example, you find out that there's a lot of crime activity and shootings and violent crime, if your niche is investing in Class D properties and Class D markets, maybe that's okay with you, but in my case, that wasn't my criteria. And for most people that approach me with evaluating deals or having that second set of eyes, it is not. So you would be surprised how many times they haven't taken the time to review the property. And that's important, because if you're in a high crime market, right, that impacts your insurance, your ability to recruit property managers, tenants, ability to raise rents and whatnot. So it definitely impacts the numbers in the business plan. Or there are a lot of times when I hear from brokers, oh, this is an up and coming area. And then I talk to my boots on the ground or the property manager, and they say, well, it's been up and coming for the last 10 years and it hasn't really come up yet. And so again, important to know, because those rent growth assumptions that you may be counting on may or may not occur. or areas with low household income or high delinquency. That would be another market criteria that may impact your business plan and the ability to raise rents. Which then brings me to the next point. The next item that I look at are the rent growth assumptions. And so those are, again, very market specific and depends on, are you looking at primary, secondary, tertiary markets? Definitely the last couple of years have been very unusual with the dips and spikes during and then post-COVID. In certain markets within the country, like Tampa, Orlando, for example, have experienced unprecedented rent growth. Are we going to continue seeing those double-digit rent growth trajectories? Probably not. In fact, in some of my markets, we've already seen some moderation of that. Not necessarily rent declines year over year, but more moderate rent growth. And alongside with that come vacancy assumptions, right? Given the limited supply for many markets, vacancies have been at unprecedentedly low levels. Will that continue? Maybe, maybe not. But again, when I evaluate a deal, I like to look at not only at the current vacancy situation, but also at the past longer term historical trends to figure out what does normal look like for that particular market. Expenses is another factor that I often see is overlooked, and particularly insurance, tax, property management fee. Again, that goes back to knowing your market, right? You may often see in broker memos tax rates, tax expenses either not changing or marginally increasing. And that may or may not be true, right? Certain markets assess the property at the point of sale. In others, it happens every 5 years. In others, happens every year. So you need to know that and factor that in your analysis. Same thing with insurance. Certain markets, and again, Florida being one of my markets, has seen unprecedented growth in insurance costs. And last year, 400, 500 expense cost per door per year may have been reasonable. This year, probably you're looking at 600, 700 a door. But again, will that apply to every market? Not necessarily, but knowing those specifics and adjusting the expenses accordingly, again, helps you be more conservative and most importantly, more realistic about what to expect when you start operating the property. Speaking of operating reserves is another item that I sometimes see neglected. And if you're looking at a newer asset versus an older asset, that also drives how conservative or aggressive you want to be. But especially in the current environment, I think it helps to have additional cushion, more cushion versus less. So if you had asked me last year what I would look at, probably 4 months. This year, probably 6 months of operating reserves. And if you want to be more conservative, include even debt service in that number. So it really boils down to, again, what is your risk tolerance? What are the market dynamics? How conservative or aggressive you want to be. Alongside with reserves is the CapEx budget. We're continuing to see cost increases, right, in labor, materials. Although the supply chain constraints have alleviated to some degree, they're still out there. Freight costs are still high. And so probably being more conservative on that front and accounting for that additional cushion, whether it's 10, 15, 20%, in order to leave room for those fluctuations of labor and materials is probably prudent in the current environment. The last thing you want to do is be surprised and find yourself in a situation where you cannot fully execute on the full business plan, or even worse, having to make capital calls to fill that gap. Cap rate is another item that I very diligently look at, and both the entry cap rate as well as the exit cap rate. And there are a couple of ways you can approach it. And again, the entry cap rate is the market cap rate, which may be different than the cap rate that you purchase the property at. And adding additional cushion or 10, 15, 20 basis points each year to arrive at the exit cap rates. And again, there are a couple of ways you can approach this, whether it's starting off with a slightly higher than market cap rate or including additional cushion as you increase the cap rate year over year. Of course, if we knew where interest rates or cap rates would be, we would probably be doing something else. But again, I think in the current environment, it's safe to assume that those will go up. I think if assuming cap rates will remain flat or declining at exit is a risky proposition. Now, if they do, and you've assumed otherwise, then you're better off. But again, you don't want to be surprised on the back end. And last but not least, the finance terms and making sure that the finance structure matches what your intended business plan is. If you're looking for a shorter term project, 1 to 3 years, probably looking at bridge, maybe more appropriate than long-term permanent financing. In the current environment, definitely getting fixed rate debt minimizes some level of uncertainty, or hedging the interest rate via swaps and interest rate caps. So again, making sure that the finance structure that you put in place matches your business plan. So I know I talked a lot, I shared a lot of information with you guys, so I will pause and happy to take any questions that you have.
Thank you, Vessi. Thank you very much. That was very thorough.
Yeah, very good.
And you didn't open the fire hose, right? It's a sprinkler. That's good, right? So there's some people here who said that there was the one person that said that some people here are newer. And so when you said a few things, I was taking notes, right? And the question is, it's about when you first started, and you said you made a goal that within 12 months you acquire your first property, correct?
Correct. Mm-hmm.
So, what are the things? What are some of the things you did for those who are just getting started out, and for those who've made goals and wondering what's going on? How come I can't reach my goals? What are some of the things you did to get that ball rolling? What are some of the steps you followed to get to that goal that you got that property within those 12 months? What did you do? What are some of the things you did?
There are a couple of things. One is joining various communities in the beginning, whether bigger pockets or conferences. Like I went to the Michael Blanc, at the time it was a virtual conference, talking to investors through online. At the time, most meetups were online. Now they're more in-person ones, and really getting the that initial, if you will, set of advice. And for me, that next step was joining a coaching program, because a lot of those successful people were noting how that helped them, right, accelerate their growth, avoid mistakes. And I figured, well, I will just follow in the footsteps of success. And so joining that coaching program, I think was also another action, if you will, that helped me get on the path or accelerate the path of getting that deal done. And taking action, and at the same time not getting discouraged, right? It wasn't, like I said, easy along the way, and going through 200 deals, that required a lot of stamina. It was definitely like running a marathon and taking it 1 mile at a time, 1 mile at a time, 1 mile at a time. And you often see, right, people posting, hey, I closed 5 deals this month and every month, and it's like, wow, what am I doing wrong? But again, it boils down to what your investment criteria and what your goals are. In my case, I also intentionally focused on the market, on a superpower such as underwriting. And I just stayed focused and kept at it, and taking those daily actions, analyzing a deal a day, picking up the phone, calling brokers, and really going beyond my comfort zone on many occasions. So surrounding myself with like-minded individuals, educating myself, taking action, and really being focused on taking those daily, small, consistent, but persistent steps. I would say those would be the key factors.
Okay, thank you. Thank you. Does anybody else have a question?
You mentioned your criteria. Do you mind sharing that with us?
Sure. So for the market in particular, what I look at is job growth, population growth, income growth, quality and diversity of jobs. These will be the top criteria when I look at a market. And then within a sub-market, I look at household income, at least 40,000 or more. I look at poverty rate. I wanted that to be no higher than 15 to 20%. The average rent amount, and the crime rate activity. So once of course, I have since zeroed in on my markets, which are within Florida, in particular Tampa, St. Pete, Central Florida, and Jacksonville. But within those markets, once I find a property, I take a look at the neighborhood in that particular submarket to see if it fits the submarket criteria.
Thank you. Thank you.
Anyone else? Have a question? I have a question. That's for sure. This is you did, it was an awesome presentation, Vessi. Really, thank you. A lot of times people come here, come into this meetup here, and when people talk about adding value, they say, I'm new, I don't know how any value. What do you say to people like that? What do you say if somebody comes in new and they say, I don't have no value? What do you say to those people?
You have a lot of value to bring. And figure out what are the things that you're passionate about, what are the things that you enjoy doing, and what is a skill set that you have, and combine the two. In my case, I enjoy looking at numbers, I enjoy looking at analysis. Between my day job and past experience, including in residential real estate, I had developed underwriting skills, although I'm an avid learner, so I will say I continue to hone in and improve in that area, and I think one can never know or learn enough. But you definitely have a lot to offer. So it's really asking yourself, what is it that I'm passionate about and what I enjoy doing, and what are some skills that I can align with that passion and interest. And then finding people who have that gap or have that need where you can plug yourself in and help others and add value to others.
And since I'm asking the question, you said, listen, this is me. Like you said, information, education comes. The only way you're gonna find out, like Yona White says, if you ask. So you said some sources. What sources do you use to get to the bottom line of your criteria?
So for markets, for example, there's a ton of public information, specifically when you're looking at employment trends and population trends. The original sources, of course, are the BLS.gov or the census site. There are a few other sites that I've found helpful that present their information maybe in a more easily digestible manner, although those are not always updated. But like city-data, bestplaces.net, Data USA, IO. These are just a few to get, again, income, population growth, job growth, taking a look at some of the sub-markets. For crime, spot crime and crime grades are sites that I look at. Of course, this is all public data. Once I've zeroed in on a property, I always like to get that vetting done, if you will, by third parties, namely property manager or boots on the ground. There are a lot of public sources for rents, for example, like Rentometer or apartments.com, but those are not always accurate, and often they would give you what the listed rent is versus the actual rent. So nothing can replace getting that local knowledge from the property manager, for example. CoStar is another data source where you can validate rents, although at a point of time, rents were rising so quickly that these CoStar reports that we were getting were pretty much outdated. And somehow for tertiary markets, I've noticed their data is not always very comprehensive, probably due to more limited information. So it's really a combination of sources that that I look at and kind of check off one against the other. And it's not a perfect process, of course, but it's a good starting point.
Thank you very much. Anybody else have a question? Okay, so nobody
Yes,
else.
I have a question.
Go ahead.
Yeah, in markets where you're not there, you talked about boots on the ground, and in particular, wondering how you go about finding your property manager, and if you're doing rehab, like your contractor or project manager.
Yes, so a couple of ways. For example, for the Florida property, one of my partners lives in Florida. So that's, I would recommend that to everyone. Definitely have a boots on the ground on the JV or GP team. With respect to the property manager, the current one that we have in place, I found through a referral from my Orlando property management team. They knew someone in Tampa, and I interviewed them, walked through a very specific set of questions to really zero in on what is their level of experience, and then what is their management philosophy. And of course, last but not least, the fees, which are just as important, but their management approach, go-to-market strategy are even more important. So going through those sets of questions as well was something that has helped me vet those property managers. And I leveraged a lot of my experience from the single family. Now I know, again, multifamily is a different segment, but some of those questions are very similar in nature in terms of their management strategy, management philosophy. So, and I've had, knock on wood, so far good success with some of those property managers. So leveraging that knowledge from past experience and transferable skills onto multifamily.
Thank you.
Mm-hmm.
So once again, are there any more questions? Okay, so before we thank Vessi in for a time, I'd like everybody to please turn your camera on. Everybody, please turn your camera on. Thank you. Oh, that's right. Fix your hair, Marina. That's right. Fix your hair. I know the story. Oh, let me get my due. Because yeah, they say when your hair is right, your business is tight. So, Charisma. Thank you, Charisma. Appreciate it. SK, Angel, Halo, please. Bill Gross.
Sorry.
Are you there, Angel? SK, picture on, SK. Camera on. Come on, Angel, with the Halo, please. Bill Gross, see there, Bill? Okay. I'm gonna hold this up. Everybody smile. 1, 2, 3, show a pretty face and a pretty smile. One more time again, I take 2. Thank you kindly. Thank you kindly. So Vessi, I'd like to say thank you. I'm sure everybody else said, let's say thank you too for coming on as a guest and showering us with all your knowledge and experience and speaking all that gem dust all over us, right? It was a wonderful presentation. Thank you again. Lawrence Waxman, Mr. International, host of Financial Independence through Small Multifamily Investing.